A very good morning to all of you. This is Magdalene from Itus Capital, and I'm delighted to welcome you all to our annual investor call for the calendar year 2023. I'd like to inform that all the attendees will be in listen-only mode, and after a presentation by our founder and fund manager Naveen Chandramohan, we will have the Q&A session. So our focus today would be on our portfolio positioning and views on the market. From here on, I'd request Naveen to take over the call.
Good morning, everyone, and thanks, Magdalene, for this. Continuing on what Magdalene said, I would first like to thank all of you guys for taking time out to join our call. And we'll take you through the calendar year 23, what happened through the year, how do we see things today, and what do we expect for the next year and the years to follow. So 23 was a very interesting year, and today we are in the middle of a market where pretty much the entire world agrees that India is a place to be. So that's no longer the question. But when you are in the middle of certain markets like this, where there is a lot of optimism, maybe some call it euphoria, some call it for the right reasons, because there are strong earnings growth backing this. It's also important to understand the path that got us here not very long ago, but just 12 months back, right? If you just look back on the notable events in 2023, it was very significant. When we started the year, in fact, in December 22, I had written a note to all our clients saying that this is going to be a great year for positioning, and there is going to be volatility. Many people forget that the first quarter of calendar year 23 was volatile. There were announcements from the US where a bank called the Silicon Valley Bank filed for closure. In fact, if you combine all the state banks of the US that actually had required the FDIC line for it to come back, just to put it into perspective, the total dollar value of FDIC protection this year was 3 times the total dollar value of protection in 2008. Right? Just to put it into context, when Washington Mutual filed for bankruptcy in 2008, the FDIC line that the Fed tapped was roughly around $175 billion. In the first 5 months of 2023, the FDIC line that the Fed tapped was close to $545 billion. So this was not a very easy year in terms of digesting headlines either, though it doesn't look like that's how we are ending December 23. The VC market had slowed down, rightly so, because 2021, there was quite a lot of excesses from the flow of money. Inflation had hit a 10-year high as well. All 10-year rates saw one of its highest levels that we've seen in the last 5 years. And today, things are a lot more calmer. Back then, if I had said anything around the markets, nobody would have said that this is how we would end these markets. While there is a lot of interesting views on India, India was not the best performing market in calendar year 23. Quite the contrary, there were both US, there was Brazil, LATAM, Russia, multiple countries, including DAX, that have done really well. What is though standing out as far as India is concerned is from a consistency perspective, over the last 3 years, we've seen very strong returns and we've seen much lower volatility than usual, which is what is attracting foreign capital into the country, because there was always an excess risk premium placed on our country, primarily because of 2 factors, us being an emerging market country and second, for currency depreciation. And both of that, for the first time, I think FIIs are willing to take that risk from a perspective of stable earnings growth as well as stable policy at the top. Now, breaking down at a very top-down level, where did India's returns come from? I just broke down to you saying that 3 years, our markets gave a cumulative 55% return. Now, the returns that one generates is the combination of earnings growth of your companies as well as the PE re-rating that the market gives you. Now, what we as analysts look for is companies that have the ability to grow earnings. And when you position yourself well, through a combination of sentiment, flows, and liquidity, there is a chance and a probability of a PE re-rating. PE re-rating cannot be quantified. It is given to you by the market, and that's where the element of positioning comes. So if you break down the years of growth of India, your earnings growth in the last 3 years is 57.5%. As a result of which, there has not been any alpha from a PE re-rating perspective yet, as far as India is concerned. And that is what is interesting around why India can be viewed as neither too cheap nor expensive. Right. So there are pockets. And here, when I say market, I'm purely referring to a Nifty 50. I'm not going down the market cap curve here. I'm only taking the top 50 companies and doing this analysis. Now, where did US returns come from, though? Why is US also doing so well when at a time the Fed's balance sheet is actually come down? So if you look at this chart, 2008, if we were at X in terms of money printing in the US, 2020 took us to 3.5 times X, and 2021 took us to 4.5 times X. Versus that 4.5, we have come down a bit. So the Fed has actually delevered its balance sheet a bit, not significantly. We've not reached 2020 levels. We have to get there somewhere because the balance sheet has to delever, or Fed might take a call that they keep money printing and they keep inflating their way out of debt, which means inflation is structural, not transitory. And that's something that we'll have to see. And I have my own views on it, which I will discuss later. What's important to understand is while people keep talking about liquidity coming into the system, enough and more dry powder, all of this dry powder is actually going into money market funds, right? So this chart below shows you the actual volume of money market funds that is in the system, which is roughly around $6 trillion today. It used to be closer to pre-COVID, $3 trillion. So what has happened, and that makes sense because as the interest rate goes up, instead of, if your equity yields in the US, which is currently 3.4 to 3.5%, is more suboptimal than investing in money market funds, which gave you roughly around 4.5 to 5.5% early part of 2023. So many people look at this and say this is dry powder for equities. I would like to slightly differ from that argument. I don't think this is dry powder for equities because this money is actually invested from a yield basis, not from an equities perspective. So it's important to understand that while balance sheet has expanded, it's not necessary that all of this has to come into equities, which is one of the arguments that many economists make, saying that this is the dry powder in the system. Now, it's also important to understand another market when sentiment is not in your favor, what happens. See, it's really interesting that China's returns over the same period is negative 34%. When I say China, I'm talking about a similar equivalent of Nifty 50 for China, which is the Shanghai Composite Index. Now, it's not that Chinese companies are not showing growth. That's a misnomer. And that is what is actually wrong because Chinese companies over the last 3 years at a CAGR basis has actually grown at around 6.5 to 7%, which is in line with their GDP growth, right? So 23% cumulative growth. But what has caused a significant drawdown and there is a sentiment change is a PE rating. And that is what the market gives you. That's something that you cannot price in. So the market does look cheap. And for people to realize that valuations are cheap, this is predominantly what is happening within China. So just because you buy growth and just because you buy it at a sensible valuation does not mean you will make money. Those are the ingredients to make money. That is not a guaranteed as long as your sentiment has to be there. And that is an important factor because for the last 2 decades, our sentiment flip-flopped. For the first time, our sentiment seems to be on track. With this as the background around what has happened in calendar year 23, we'll just break down Itus's own performance. We've had a reasonably good year this year, beating the Nifty by slightly over 4.5%. This puts our cumulative return since inception at 271% against 167% against Nifty. As many of you are aware, we run a multi-cap fund. So one of the things that I try and do, not on a quarterly basis, but more so on an annual basis, is to try and explain to investors why do we benchmark to Nifty 50. And I wrote this in 2017, and I continue to believe that this is what you will see in the next cycle of growth of India as well. In the next 5-7 years, it is going to be very hard to beat Nifty. Nifty will not only be your best performing index, it will also be your lowest volatility index. And our aim of a fund, while it is easier to compare it with Nifty 500, is to beat Nifty 50. And one of the aspects of how we've always structured the fund is to ensure we manage liquidity and we don't manage returns. What that means is we have risk caps on how we think about small caps, how we think about liquidity, and how we think about transitioning risk across market caps, which I'll explain in due course of the slide. Here again, this explains where has our outperformance comes from. So typically, you will not, or rather, you shouldn't see in a roaring bull market, Itus do 100, 120, 130%, which many funds you may have seen in the market because of the kind of risk and how they are positioned and what they are structuring for. For us, it's always about saying, how do we protect downside across markets? And in bull markets, we continue to capture the upside, and that's where our overall alpha from a medium to long term will come from time. And this slide explains the same in terms of how we've done across both down as well as up markets on a quarterly basis since inception. One of the characteristics of our portfolio, at a portfolio level, when we think about construction, the return on capital employed of Itus has always been above 1.5 times the cost of capital. What do I mean by that? Just because you get growth doesn't mean that it has to translate into shareholder IRR. That growth means a good company translates earnings growth into cash flows. And promoters or the management teams reinvest those cash flows. We as minority shareholders would only make those returns when the incremental returns of the management reinvests exceeds your cost of capital. For us, at a portfolio level, we want that to be roughly 1.5 times cost of capital or expanding towards that. That's how we think about the strength of the portfolio across time. One of the things, while I told you about the 7-year track record and us beating Nifty fairly consistently across time, what gives us the right to believe that we will continue to do it, right? And this goes back to the fundamental aspect of how the portfolio is constructed. If you look at the long-term trajectory of Itus and the long-term trajectory of Nifty, which is what we aspire to beat consistently, you will see two characteristics. You will see the fact that the cash flow generation at Itus has always been consistently higher than that of Nifty. And the cash flow generation of, the return on incremental capital at Itus, again at a portfolio level, has always been consistently that of Nifty. Now, on a quarterly basis or a semi-annual basis, there might be oscillations, but we don't react to quarterly or a semi-annual. For us, it's about seeing the trend and ensuring that at a portfolio level, even if there are 1 or 2 companies in the portfolio that go through headwinds, at a portfolio level, the structure doesn't change. And that's the importance of portfolio rather than just focusing on stocks. Now, the same thing, if you break down what percentage of the portfolio falls under what part of our bucket, this is where the difference comes. Where from a consistency-based perspective, over 3-5 years, which is what I would tend to call as medium term, you would see that more than 80% of the portfolio has what I call 1.5 times higher return on incremental capital, at least, than the cost of capital. Whereas that number for Nifty, as we speak, on an average basis, is more like 54%. Now, today, as you go down the lower market cap curve, many of the companies may not show this level of consistency. So one of the reasons I've always said that consistency is more important than one particular year of extremely strong returns is primarily this. because I, as a fund manager, don't know which year you're going to get abnormal returns, and I can't predict that. But what I can do is to ensure that as long as you stay invested for 3, 4, 5 years, those returns come back into what the mean normalization is. While a particular year, like we saw underperformance in the fund in 2022, where earnings still grew at 19%, but our returns ended up at 3.5%, which is what prompted me to write that note in December 22, saying that this portfolio is extremely underpriced. While as an investor, psychologically, you want to invest in a rising market. That's how humans tend to react, and that will never change. Our aim is to also explain to investors when the stability of the portfolio does not get tested, and it's only the price that gets tested, why it is a good time to add capital. The third thing that I wanted to highlight in our call is how do I assess our sector exposure and why are we positioned the way we are, right? And it's important to understand because our portfolio positioning is very, very contrarian to Nifty positioning. What do I mean by that? I'll just give you some data points. Today, 40% of Nifty is financials. Our exposure is less than almost, it's approximately 30% of Nifty's exposure, which is in financials today. So we as a fund are underweight financials. Where are we overweight significantly and very contrary to where Nifty is capital goods, auto and auto components, infrastructure, power. So basically, like I have explained on prior calls, this cycle, according to us, is going to be a supply-driven cycle. A supply-driven cycle basically benefits GDP-facing sectors. GDP-facing sectors have gone through 11, 12 years of drawdowns between 2009 and 2020 to 21. And you are now seeing an early part of a very strong recovery. That is where many of the returns got front-loaded. But I continue to maintain that while you might have renormalization of growth, you may not get the 30% growth that you saw in the last 2 years. The growth will still continue to be strong at low to mid double digits. That is where we want to be positioning. So what we've done here is to just break down, for example, if we are overweight on auto and auto components, which is clearly visible in this at a 22% exposure, what is the growth rate that this 22% exposure is showing us? And how is that translating into the bottom line? So, for example, you are seeing for the first time in a decade, auto companies showing operating leverage. They've never seen that from a cycle perspective for the last 10 years. And hence, not much money has been made on auto. And that is what I think you will see reversing. It is not going to be a straight line. Please, many people feel that auto will behave like consumer. No, auto will have some amount of chunkiness, some amount of variability. Same thing for cap goods, same thing for power. But from a cycle perspective, this is where you will see much, much stronger growth. And this basically breaks down the remaining part of our growth cycle around where are we positioned. So broadly, if I just take a top-down view to this, it's looking at 4 sectors where we are overweight, where the sum total of Nifty's weight is low double digits at best. Ours is closer to 40%. And broadly, us being underweight consumer discretionary and banks, which is the dominant portion of where Nifty's exposure is. That's the positioning of the portfolio, which I don't see it change significantly in this cycle. When I say cycle, I'm talking about it from a minimum 3-year perspective. With this as the background, I'll just quickly go down to the churn rate of the portfolio this year. So if I measure the churn rate, our historical churn rate has been roughly oscillated in the high teens. As many of you know, we don't believe in buy, holding, and forgetting. I'll never come to you and say, this is a great company, let's hold on to it for next 10 years. I can only say that with confidence if someone tells me that the people behind the company don't change. Because end of the day, a company doesn't mean much to me without its people. It's people who reinvest capital. It's their decisions that we are backing. And if they do that well, because of the edge that they bring, that will translate into shareholder returns for us as minority shareholders. So one of the things that we did as we entered Deck 23 is reduce our weight on small caps fairly significantly and increase our cash balance. Now, why do we do that? Because as a multi-cap fund, we've always transitioned from market caps depending on where we find growth and where we find valuation comfort. Now, valuation comfort is qualitative. Some of you in this call might say a PE of X is cheap. Someone else might say a PE of X is expensive. And the thing about the market is that is always qualitative unless and until both of you can agree on what the growth rate of the company is. So what we've done here is just to explain in this year, from Jan 23 to Dec 23, what is the earnings yield of each one of our indices in the country between Nifty 50 all the way onto Nifty small cap. Now, today, for the first time, so end of the day, we don't think of risk as large, mid, or small. The way internally we think about risk is when I invest in a sub 10,000 crore market cap company, I am actually sacrificing liquidity. Today, one needs to realize we run an open-ended fund. An open-ended fund means technically daily liquidity. If I'm running a daily liquidity, I have to manage the liquidity for each one of my clients. I'm not running a mutual fund where SIPs of someone else can benefit another folio holder. Each person is different, and hence we've never run model portfolios. So valuations become that much more important for us. So if you look at it, I always expect a higher earnings yield, put another way, a higher risk premium to go down the market cap curve. And to put it differently, I expect a higher growth rate to compensate for me going down the market cap curve. If I'm not getting this, I will not do it. So today, for the first time, the ROE of the small cap index has actually roughly equal to that of Nifty. So, which means, to put it into perspective, pre-2020, the ROE of the small cap index was 6%. Today, it is at 14.9%. That's a very healthy trend, which means incrementally, the return on equity of your small caps is expanding, and that's what you want. But that doesn't mean that you can pay up any valuation to own such businesses. As your earnings yield comes down, the risk premium is also dropping. And for us to sacrifice liquidity for a dropping risk premium does not make sense. Now, one argument on the other side of the argument I'm making is flows are so strong. Just 1 week back, Motilal Oswal raised an NFO, which was the highest ever subscribed NFO for small caps with 1,300 crores raised on day one. So if flows continue, momentum will continue and small caps will do well. That's a good argument. I can't argue against it. But again, if you go back to what I said, risk management and discipline is what we care about rather than maximizing returns. This framework will help you understand why we've been cutting risk and why have we been building a higher than normal cash balance as we go into year end. And that is something that I don't think will change for us in the near term. I just want to spend maybe 2 to 3 minutes on this slide because many people focus on stocks, earnings, and growth, and which translates into a PE-based discussion. Very few people focus on position sizing. Now, position sizing is what determines concentration in the fund. For us, I've always said concentration is not a given. We don't start off by saying I will only do 15 to 18 investments. That is a function of earnings growth, which is very strong today, as I just showed you, and valuation comfort, which I think is neither too cheap nor too expensive, at least if you look at it from a Nifty perspective. We are in the median end of the range. When I have that kind of a market, I will not concentrate. What do I mean by that is most of my positions would either be starting positions or it would be base size positions. Fully sized positions at cost today is a lot harder to take at these valuations. We might scale it up over time as we get better earnings visibility over time, or if we get increased volatility both at a micro or a macro level. This feeds into how we think about the number of investments. So due to us staying invested in the market rather than us building concentration at the starting point. That's something that I wanted to highlight around how we are thinking through risk today, because this is a question that we get asked a lot. 30 investments doesn't mean diversification. It means how you want to position size depending on where reduced exposures are names which are either consumer facing or names which are D2C brands where the valuations have actually scaled up into levels that we are no longer comfortable owning. What did we do right this year? Auto actually did work out reasonably well, and I think the cycle should continue. It's one of the reasons that we focus on the data in terms of actual registrations, dealer registrations. How is the pricing power of the auto industry picking up? Is the average revenue per car or two-wheeler, for example, two-wheeler industry has gone through 10 years of stagnation. And the thesis continues to be the growth is going to be subpar. Though the growth is subpar, there are two markets and the change in dynamics that is happening. One is the export contribution of some of the large companies are picking up. And second, the model mix has changed significantly. And it's one of the reasons why you will see two-wheeler value accrete, even though the volumes are only renormalizing as we speak. So our exposure in auto will continue to be across four-wheeler, two-wheeler, and ancillaries from here. You will already see that in the portfolio, and incrementally at reasonable valuations, we might choose to add more risk here. How do we think of the portfolio construction today? Like I said, we are deviating significantly from Nifty, right? So I need to explain why are we doing this? We're not doing this because we want to be different. We're doing this because for the first time, after a long time, we're seeing structural changes. So I'm just going to combine four graphs in order to paint the thesis around how we are thinking about this cycle. First, obviously, the private sector sanctions by banks has increased in a significant way, which is your proxy for credit growth. So what you actually saw in calendar year 23 was non-linear growth in public capex. Going into calendar year 24, as you go into elections, it's our belief that you're going to see a renormalization of public capex, but private capex taking over. And hence, loan book growth should not slow down. Second, on the real estate side, inventory levels are at its lowest ever that we've seen in the last 11 years, as a result of which you see new supply picking up and getting absorbed in the system significantly across geographies. We've seen this cycle before where developers, India is one very unique country where no developer has ever expanded beyond its home turf. They have tried, every developer being the largest have their home turf, but no one has expanded beyond their home turf. They tried in the previous cycle, it failed, they had to scale back. Again, now we are they're trying to do this again. We'll see whether this works out. It's not going to be easy though. Third, in terms of the core sector facing economies, economy facing sectors, you're talking about cement and steel. You still don't have oversupply. There is a deficit, as a result of which there continues to be a net deficit on the power side as well. And fourth, put together all of this, how do we think about companies, and why do I say private capex is going to come in a slightly more aggressive way in calendar year 24? Because balance sheets are not levered. Most of your growth that I just showed you, where 56% 3-year growth has actually translated into real cash flows this time. As a result of which, your reinvestment is not coming from re-levering your balance sheet. It is coming predominantly from cash flow generation. And hence, when companies take up debt, they're doing it with much healthier balance sheets. And this is across sectors, be it hospitals, be it hotels, be it travel and tourism, be it iron, steel, be it commodity-facing sectors like metals, etc. The thought process is what I just summarized. I do expect private capex picking up steam post general elections. Lot of interesting themes in the import substitution, project announcements, and cap goods should continue to maintain positive momentum. There are all of this would result in credit growth. And one of the things that you need to monitor, which is at least something that we are monitoring, is small ticket personal loans are picking up in terms of slightly higher delinquency. So you might hear noises from RBI. RBI does act ahead of the curve versus many other central banks. So are borrowers taking small ticket personal loans to fund EMIs of other loans? It's not a healthy sign, but you are going to see that in this cycle. This will not manifest into, this is very, very, very early stages of a credit cycle growth, but this is something that one needs to keep a trend on, because the 30 plus delinquencies, which is basically how long it takes to pay your loans, especially in the sub 50K segment, which is your microfinance segment, is picking up. Again, this is not something as a concern, but this is something to flag as well, because end of the day, just because you get growth doesn't mean everything is rosy either. The way I want to end this is just to recap calendar year 22. We made it is more of how do we think about 4 predictions. First thing we had said was large tech in US to see more downside. This was completely wrong. That's where one of the highest returns were made in calendar year 23 in the US. But I continue to maintain that risk reward is not right there. That's a space that I don't think from a structural perspective makes sense to be investing in. But 23 obviously disproved that so-called prediction. And also spoken about first deal where oil is transacted in RMB. You saw that happening, and you also saw that as a structural trend translating with USD depreciation happening. And I think while you might see some normalization, that trend should continue according to us. We've spoken about China equities to have a strong year supported by domestic liquidity. Though you saw domestic liquidity, Chinese equities continues to be fairly weak, and that doesn't seem to be changing anytime soon from a sentiment perspective. But from a risk reward perspective, if you are a long-term value investor, one cannot ignore China as far as we are concerned. In all our FII conversations, FIIs are not incrementally allocating capital to China, but that doesn't mean they're getting out of China in a hurry. Right? Incremental capital is moving away from China, but it's not like FIIs are saying China is uninvestable, at least according to what we are talking to FIIs. What do we think about 2024 in terms of how we view the market today? I think US as a geography continues to offer least risk reward. We said that in 23, it was wrong. 24, we continue to believe the same thing. EM should continue to outperform. I think that's the cycle that we are in. India equities, this is our belief. This should be a very good year to construct portfolios for next year and the following year's returns. That's how we think about it. We could certainly be wrong from how we think about a base case, but us building higher than normal cash balances in portfolios, taking longer time to deploy is a consequence of what we believe as we speak. Many people believe that we are going into a rate cut cycle. I don't think so. I think if the Fed actually cuts rates, I think it's a big mistake. I think it's going to be politically influenced because you're going into October and November elections. They might want to show a strong economy in order to get into the elections. That could be a reason for them to cut rates. But I continue to maintain that we are in a higher than normal inflationary cycle. And I think in the next 4 to 6 quarters, you are going to see 10 years touching 5%. It is a counter consensus call, but that's where I think we are getting to. The only way Fed can delever its balance sheet is inflating its debt. Commodities to do well. I think commodities will do well in this cycle, including the likes of uranium, where alternate sources of power are getting explored. China is investing significantly in nuclear, and uranium is the raw material for that. You're going to continue to see that trend. And this is more of something that just to watch out for. Gold, while gold should do well in this cycle, it's important to just see because in the previous cycle, while I don't have a view on Bitcoin, but at the same time, they're talking about ETFs getting launched. ETFs getting launched means democratization of Bitcoin. It means my and your grandmom can actually buy Bitcoin as well as an ETF, which they could not because they had to own a private key, they had to own a wallet. It was technologically slightly more complex. It was not open to all. This opens it to everyone. So from an adoption perspective, it can become extremely broad-based, and that has larger ramifications from a liquidity and adoption perspective, it getting more retailized as we speak. So it's an interesting trend to watch out for in 2024. That's how we think about this calendar year. So with this as the finishing slide, I'd close this presentation. I wanted to thank you again and be happy to answer any questions in this forum.
Thank you, Naveen, for the lovely presentation. Participants can now type your questions in the Q&A box. The identity of the participants are protected as the questions are only visible to the panelists. Naveen, I have a question now. How has the power sector turned, and what would be your outlook?
So, the first, in order to answer a slightly more macro question, I would always go to history. So when you go into the history of a sector like power, it has two characteristics, especially in our country. One, it's a commodity, and second, it is regulated. So because it is regulated, free markets can never determine the price. There will always be government intervention because government is present on the production side, on the transmission side, as well as on the consumption side. So the entire value chain, the government is present. So end of the day, the power dynamics are going to be driven by supply and demand. For the first time in the last 2 years, you've seen demand exceeding the supply. And in a sector like power, which actually went through maybe a decadal period of no growth on the supply side, supply just cannot come in the next year. People will invest, but for you to set up capacity takes time, be it solar, be it thermal, or be it coal. And as a result of which, you just can't go green in the next 2 years. Even if you have an intent as a country of going green, it takes 10, 15, 20 years. So in terms of, while you're going to see a lot of supply come into the equation, from a production perspective, it takes time, and your demand is going to actually continue to grow at high single or low double digits. Supply is coming in at 8 to 9%. Hence, the deficit is still going to be there. As a result of which, I continue to believe good production good producers will benefit. Now, what is good production in the power sector, where you are producing a commodity, is someone with the cheapest cost of capital, because it is going to be a debt heavy business. So someone who has the ability to borrow the cheapest should benefit, and hence NTPC. So that's how we think about the entire power structure from a production perspective. There are going to be interesting value chain beneficiaries out of it also. People who produce, for example, transformers, or people who produce cables, but that has played out fairly well, and valuations are rich. But I think it doesn't mean that you will not get better periods for you to invest there as well. So from the production side, we are invested. I think from the value chain side, we would want to add over time. So that's how we think about the power sector, purely from a macro perspective. I'm just giving you a top-down view around this.
Thank you so much for that. What would be your view on the EV uptake in the portfolio, both Tier 2, Tier 3 infrastructure cities? And are you looking at what would be your view in the mid-term and the long term, say a 2 to 5 year period?
So I think, I think again, I'm using history as a reference, right? If you use one of the most penetrated markets, leave China out, because China does get a lot of intervention and help and support. And specific companies do that, and hence scalability happens at 1 or 2 companies. That is not how the Indian markets work. So if you look at US, a company like Tesla had a 15-year runway from when they started commercializing their vehicles. But many people forget that even with a 15-year runway, in 2017, Tesla was 5 days away from bankruptcy. right? If you can just look back in history, in 2017, Elon Musk tweeted saying he just saved the company by fundraising. That was his controversial tweet that came out, where he's still questioned by the regulators on that. So I think end of the day, it goes back to the fact no EV auto is a competitive and a difficult market. So will I be looking at an EV OEM, and do I understand who has the right to win? Answer is it's difficult, because auto is cyclical, EV is also going to be cyclical. Then you have charging infrastructure. Charging infrastructure generally tends to get controlled by the government. You need distribution for that. So you will have private companies play out there, but scaling that up is not going to be easy because it is capital intensive. Then you have batteries. Battery again requires huge capex. I think the right to win rests with the likes of a Reliance or a Tata, because roughly around 10 gigawatts of battery capacity requires $1 billion. And you're setting up capex without realizing who has the right to win. It's still very, very early days where technology keeps changing. I think one place where the right to win for in EV that very clearly exists for us, which there is no company in the public market, but you will see that in this decade, is battery recycling. Whether EV picks up from a battery perspective in India or not, India manufacturing where recycling for the world picks up is a very, very clear, strong proposition. There are a few companies in the private space that we keep talking to, which will eventually get public this decade. That's a space that is interesting. And over and above this, there are interesting ancillary companies that supply very niche R&D IP, which is what I called as import substitution products to the likes of Mahindra and Tata, which are the EV four-wheeler OEM leaders today. So those are companies that you will find in our portfolio. So broadly, will I look at an EV OEM? At valuations, yes. Structurally, no. Battery recycling and battery right to win is still not clearly established. Battery recycling right to win for India is very, very clear. And ancillaries, because of import substitution and manufacturing, the right to win will exist for certain niche players, which we will own, and which some of which we already own, and we'll continue to add in our portfolio. So broadly, this is how we think about the EV space.
Thank you, Naveen, for that. Now, what would be your view on the banking sector with anticipated rate cut in the second half of this year?
So I don't know whether India will cut. I don't see the reason why RBI needs to cut. I'd be very, very surprised if they cut. So that's not the base case at all. I think if any cuts are expected, it's expected from the Fed. And I already told you, if they cut, I don't think it should. It is a good sign if Fed cuts. Like unlike many people, what they make it sound, that's what we think internally. Now, whether rate cuts happen or not, I think one thing is clear: the loan book growth for many of the top tier banks is going to be robust. Why are we underweight banks? Primarily because for that incremental loan book, is the ROE going to expand? For the first time, I'm not very clear. It's a given. In the previous cycle, where we were overweight banks pre-COVID, and actually into COVID and after COVID, where we significantly bought banks, the ROE expansion was clear. As banks are recovering, balance sheets are clear, competitive intensity has increased in a significant way. So growth is not the problem, incremental ROE is the problem. And hence, if incremental ROE may not be what you were used to in the previous cycle, I'm not sure what is a reasonable price to book anymore. What is cheap and what is expensive. So while banks do look optically cheap, many of them, including HDFC Bank, we are underweight, because we see better areas of growth in the 4 to 5 sectors I spoke to you about. So unless and until something significant changes, I don't think we will only be tactically owning banks, but not from a structural perspective versus Nifty at least.
Could you elaborate more on why India will be neutral to negative this year? Because with the roaring market.
So I mean, I always say, anytime I give you a view or a macro call, it can only be 50% right at best. I just told you 2023, we made 4 predictions, 2 of which was horribly wrong. And so end of the day, I just feel money making cannot be a straight line, right? I don't think the job, in order to make money, one has to go through periods of cycles. not just in India, across the world. Today, it's just become fairly easy where pretty much anyone and everyone is investing themselves, which is a good thing because money is coming into the capital markets, but also with the belief that their expectation on the returns that they make is now has gone up to 25 to 30%. And I think it's very easy for the human mind to extrapolate what happened last year into the next year. Sentiment is very strong, flows are very strong. But again, like I said, I don't think liquidity conditions are going to oscillate. This is purely from a psychological perspective. What I think when I talk to people, where people's expectations have gone to returns. End of the day, when we started in 2023, people were uncertain. And we had written a note saying that's a good time to invest. Today, it's a reversal of that. People are extremely bullish. People want more of small caps. And I think from a liquidity perspective, I don't think that is warranted. But again, I just caveat the statement, bull markets can last longer than whatever I think. So for me, my job is to ensure we manage risk reward and ensure we manage discipline, not to tell you whether markets will correct or not. But history tells you that every time sentiment becomes lax, where I cannot point out to any risk that I see, that's when risk surfaces. So purely from that perspective is what I'm saying 2023 is flat to negative. I could be horribly wrong as well. So I'll have to risk manage that. So that is what we do. Not say that this is what is going to happen and wait for it to happen. It's just a probabilistic view of the markets, nothing more.
Understood, Naveen. Now, how do you invest if money is given to you? Because when you build a portfolio and this year being a good year to build a portfolio and the market is at an all-time high, how do you look to build a portfolio if money is given to you in one shot?
So today, as we speak, I think for new money that is coming to us, we are maybe 40% invested as we speak. Remaining 60% is uninvested. The way I think about it, I think over the next 6 months, we should get fully invested. That's how I think about it in today's point of time. So two things I wanted to highlight. We will be slightly slower than normal, the way I expect in order to invest. We are not in a hurry to deploy capital. If every market moves up one way, we might underperform in the short term, and I'm fine with that. I don't want to be losing discipline in this market.
Got it. Thank you. Now, what would be, so we are underweight banks, financials. Now, what would be the trigger for you to move from an underweight portion to a neutral portion or maybe overweight?
The trigger would be...
And this is finished. And the thing is that lastly, your view on PSU banks?
Yeah, so I think, yeah, we could have been smarter around PSU banks. I think we didn't own SBI. When I say smarter, I would not have gone down the lower cap curve. I mean, because the balance sheets were improving and we preferred owning private sector banks because market share for them was growing. But there was a recovery story at play at PSUs. Typically, we have not played recovery stories. So I don't think we would have done anything differently with the benefit of hindsight. But even today, if someone wants to own an SBI in their personal portfolio, I think it warrants them to own it. See, like I said, I cannot own everything. There is a certain philosophy with which we run this fund. I can't change the philosophy of owning stocks, which deviates from what we believe in. That is what will cause problems. So if someone asks me for advice saying, should they own SBI? I think they should. But would we own SBI in the fund? I don't think so. So it doesn't mean that just because we don't own it, it's important to understand that we clarify what we stand for, we invest with that framework, and we don't deviate from that framework, because what I don't want ever is inconsistency. Now, with that as the framework, I still think PSU banks could do well, purely from the fact of view that the credit cycle is still not peaked out anyway. So the growth is still there. So if someone wants to do it PA, I think they could, but we won't do it in the fund. Now, what will cause us to increase and incrementally weight banks? I think getting more clarity on can ROAs expand, because I don't think I am getting comfort that ROAs are expanding anytime soon. So loan, again, I reiterate, I'm not questioning loan book growth. I think that is going to be robust, like I showed you. But incremental loan book growth means ROA expansion. I'm not very sure about that. So bottom up, we still are overweight IndusInd Bank. That's our largest exposure. Our view continues to be unchanged around that. But other than that, I don't want to overweight banks at this stage. In the next few quarters, you will see the trend. And if we see that as structurally, then maybe our view is wrong and we'll have to revisit that view. And again, I'm not saying I'm underweight banks because I am bearish the economy. I'm saying I'm underweight banks primarily because I have better pockets of growth in the sectors that we are positioned. So purely from an opportunity cost perspective as well, I see growth elsewhere.
I mean, how do you see the FMCG sector?
I think, again, FMCG is a very broad classification today because you have rural facing FMCG, likes of Marico, Dabur, maybe you can include Colgate, maybe not, but Levers. All of these are great companies having seen poor growth in the last 3 years, predominantly suffering from the rural side of the business. Then you have tier 1 facing FMCG, which are much smaller, which have seen faster growth. So I think my view is normalization of growth on the rural side should come through, as a result of which maybe the rural facing FMCG sees renormalization of growth that they have not seen in the last 3 years. To pay up valuations at which many of the consumer discretionary stocks are trading at today is something I'm not comfortable with. So purely from a valuation side, I think FMCG should grow at low double digits in a good cycle, and I expect that to continue. Now, the question is, what valuations do we own this at? Many of these are trading at valuations I'm not comfortable at, and hence we don't own many of these stocks. But there are some good businesses out there, like a Tata Consumer, for example, which should continue to do well.
Wonderful. I mean, my final question, what is your view on commodities? When I say commodities, metals, and then on gold?
I continue to believe both of them should do well in this cycle. Both metals, commodities, and in turn gold. So I would, if I was giving a macro view to someone, I would say this cycle should benefit all of them.
Thank you, Naveen, for those answers. Maggie, over to you.
Thank you, Naveen and Ajit, for the interesting updates. Once again, I'd like to thank you all for your time on this call. The recording of this webinar will be sent out at the end of this month. And wishing you all a wonderful and a happy new year. May this year be a prosperous and a joyful year to you all. Thank you all.